Hi, I'm Donna Roseman David, Senior Gift Planning Officer at the Hartford Foundation for Public Giving. Gifts of non-cash assets often seem complex. Here, we talk with Bryan Clontz, President and co-founder of Charitable Solutions, LLC, about the benefits of giving non-cash assets to charity.
Yeah, one interesting point is when you look at some of the data relative to millionaires, that their asset mix in terms of their balance sheet characteristics are that more than half of their assets are in non-cash assets. So if you look at, again, at publicly traded securities and cash, it represents about 40% of most of their balance sheets. And there, of course, leaves a lot of opportunity for other assets that they may have. But interestingly, the huge disconnect is in terms of the amount given to charity each year, which is about $300 billion. Only 3 to 5% of that come in the form of non-cash assets. So clearly, when you think about those that might be most conducive for giving, those donors that have the large amount of assets within their balance sheets, and then also actually if you look at the aggregate market where the total stock market has between $13 and $14 trillion in assets, the non-cash market, again, real estate, closely held business interests, is between 4 to 6 times that amount. So $40 to $60 trillion made up in those assets that in many cases can be by far the most conducive ways to make gifts to charities. When professional advisors are designing the charitable plans, if you went to a charitable tax seminar for a week, the one thing that you would know at the end is cash bad, everything else good. And cash bad basically means that cash generally is the worst way or the least tax effective way of making a charitable gift. The everything else good is generally defined as capital gain assets with the lowest cost basis, obviously said the other way, has appreciated the most, that's been held for the long term. And in many cases, and in fact in most cases, those assets, if you describe it in that way, would be real estate or closely held stock positions held by most affluent investors. So rather than using appreciated assets like a real estate and closely held stock as a fallback position, most advisors really should be looking at potentially as the initial asset or the most optimized way of making a gift. Wherever I go across the country, especially working with community foundations, the two most philanthropic groups always are real estate developers and closely held business owners. And many people ask me, why is that? Why are these people more philanthropic, let's say, than Fortune 500 executives or very wealthy inheritor heirs that might live in our community? And the real reason is actually fairly simple. They made all of their money off of the community. They want to be able to give back to that place that helped them be successful. And when you're a real estate developer, you want the community to be vibrant, you want it to be strong. Typically, these are the same people that are involved with the Chamber of Commerce, very active with the civic associations. These are the people that want to ensure that the place that they grew up, the place that they raised their children, the place that they were successful business people, they want it to survive well beyond them, and they want to give back. And in so many cases, they want to give back, and interestingly, and in a good way, those assets that they can give back are those that we've talked about are sometimes the most tax-effective, underutilized, and overlooked assets that can be used in charitable planning. From the donor standpoint, it's particularly good because, one, it's an illiquid asset, or one that otherwise they may not be able to access very easily. Two, it might even have specific negative cash flow implications. For example, if it's an undeveloped piece of real estate and they're having to pay property taxes on that real estate, that would be a negative cash flow situation. So at least from their perspective, it might be very conducive for them to make that as a charitable gift. But really, those tax benefits are particularly acute for public gifts to public charities. So if you were to give real estate or a closely held stock or anything other than cash or publicly traded securities to a private foundation during life, you would receive a cost basis deduction. Cost basis bad, fair market value good. So instead, if you were to give that, say, to the Hartford Foundation for Public Giving, you would be able to make a gift of real estate, let's say, receive the full fair market value deduction. The foundation then has to pay no capital gains taxes at all, and then you would be able to have a fund to be able to execute whatever your charitable intentions would be as part of that overall plan. Instead, if you gave that to a private foundation, again, that would be a cost basis deduction. So in many situations, because those assets are most conducive for charitable giving, and they're most conducive charitable giving to a public foundation, like the Hartford Foundation for Public Giving, in many ways advisors should be much more intentional about including these kinds of assets in their overall giving plans. If you have a particular kind of non-cash asset, you'd like to be able to take advantages of the benefits that I've mentioned before. Making that gift to a public charity allows that, but most importantly, that's just one gift to the Hartford Foundation for Public Giving to create that fund. Then that's one transfer. Once the gift is then sold, then that donor is able to make grants either to specific purposes that the fund has been designed for, or certainly to other charities that the donor wishes to benefit. And all too often, I've heard horror stories of advisors actually trying to approach, let's say, the 4 or 5 charities that the donor wants to benefit. And if you've ever had the fun experience, and I say that completely facetiously, of deeding over an undivided interest 4 ways to 4 different charities, if you actually are successful in doing that, you'll never do it again. It is just too complex of a process, which also means that the donor advised fund in particular is one fund that is just well designed and particularly suited for these kinds of assets. I think too often advisors and donors as well think complex assets are too complex, and they're really not. There are certainly things that the advisor must look into in terms of particular issues, and I'll cover those in a moment, but also something that the donors might think when they're actually approaching a charity with these kinds of assets. In many cases, unfortunately, most charities are reluctant to be able to receive them. So those are certainly 2 barriers that need to be crossed. From the advisor's standpoint, the issue really is A, the tax and legal complexity of the potential gift. 2, to understand what the management and holding period responsibilities might be to the charity. So if you have tenants, that's important to know, leases coming up, things like that. 3 would certainly be things as it relates to the liquidity of the asset. So how quickly might it sell? What might the sales plan be? 4, related to that, are there any buyers in the wings or any sort of potential buyers and offer potential for that particular asset? To be very careful from an advisor's standpoint, you can't have any kind of legally binding agreement. So to the extent that actually is in place, then it's likely too late to be able to make that as a charitable gift. But prior to that, many of these gifts can be designed and made to the charity, and then having that potential buyer in the wings purchase that property. So those are the real issues. I think the one issue that I do want to bring up that all too often makes it too complex in many cases is the environmental issue, clearly as it relates to real estate in particular. And that is that the environmental issue can usually be overcome very easily using an environmental appraiser to assess what risk might be there. In many cases, this is what the charity is most concerned about, but all too often in my experience, there are usually not very many issues, or those that do exist can be remedied fairly easily. So I think that's kind of an obstacle that really doesn't need to be there. And the last thing I think, unfortunately, is that many charities are not comfortable receiving these assets, as I mentioned before, and therefore their internal process of taking these in can be what I would actually say is painful in some situations, unfortunately, for the donors and the advisors trying to help them make that gift.